First up, an introduction to venture capital in case it's new for you. A very brief look at that. Some common requirements that come with investment for venture capital, maximizing your chances at getting investment, a little bit about that, as well as a bit of self-assessment for your pitch and the preparation process for that pitch. And this is probably useful considering we're coming into that end of the year when our croc pitch competition generally starts. We'll be starting those up in August, starting with the what we call Croc Camp. So please do look out at the Darwin Innovation Hub website and socials for some instructions on when that will come up if you're interested in seeking that $1 million investment. So venture capital is pretty much startup funding. It provides some resources to very early stage startups. So this is not generally buying out in exchange for equity. And it's just about always going to be minority equity we're looking at. So it's not buyout of your company. It's just a slice of your company. And it's usually in terms of looking for future growth and future equity as well. Just to let you know that this particular presentation will be recorded and put to YouTube a little bit later today. So I'm not sending out the slides so much, but it will be available to replay on YouTube through the Darwin Innovation Hub channel. Growth support then comes in the form of some mentorship around the startup journey because venture capital isn't exactly new to this rodeo. So we're very much experienced in working with lots of different startups and different styles of startups as well. So that little bit of mentorship through what the process is, some networking and introductions to other investors or people who you can partner with to make that startup journey a little bit better, whether you need access to our network of investors, our network of legal advisors, financial advisors, people who can help you out with that journey. It also offers a bit of that strategic guidance. So when you're sitting there going, should I release this new product now or should I hold off until it's perfect? That's the kind of advice we can kind of work with you as venture capital investors as well. So it's not just the cash. I know sometimes it can be just a matter of just getting a cash partner in there with a minority equity shareholding in your company, but it can also be a much closer relationship where you come on as, yes, still a minority shareholder, but we come in as someone who can offer you a little bit more advice and guidance through the process because not every startup is experienced. Most of the time, these startups are doing it for the very first time. And that's why we sort of provide a little bit more of and most venture capital firms will provide a little bit more than just simply a cash injection, but the opportunity to see more. So the importance of startup capital in the ecosystem helps to fuel a bit of innovation. If it was just left to government grants, they have a very, very small limit. For instance, Northern Territory, the Business Innovation Program funding is only up to $30,000. And that doesn't go to you, that goes to your suppliers who have to be approved through that process as well. So the government funding generally has limits. Some jurisdictions and specifically Commonwealth funding can go a lot higher than that. But when you're a very early stage startup, your options are going to be quite limited. The bigger funding tends to happen to those who are a little bit further along the journey. So yeah, it will help fuel innovation where government grants and general your own savings may not get there. It also enables a bit more scalability. I think if you've ever grown a business and tried to build, and I've done it a number of times now and been successful and a massive failure at the same time, the big lesson I learned is that at some point you hit your ceiling. You need to invest ahead in order to get that growth. And quite often it's like family money comes in and helps you to fund at least that next 2 employees that help you make that next $2 million in revenue or whatever the situation happens to be with your particular business. This is where we go, okay, well, are we in a position to be able to scale up without getting extra funding in? Sometimes you'll bring in a partner, so they'll do a 50-50 or a 51-49 partnership with you. And sometimes it's venture capital investment. Very rarely will it be banks that will give you that scale up money. They do have startup loans in banks, but they're usually around that $50,000 at the absolute most, between sort of $10,000 and $50,000, almost personal loan level, but it's indexed against your business. It helps to foster competition as well. Because there's a lot of players who are very entrenched and established in what you're doing, and you're up against them in some way, shape, or form. Even if your idea is brand new and you don't really feel like you've got a lot of competition, you're still up against someone who does something similar, or they're doing something which is complementary or somehow opposite to what you do, but they're the established player in the market. They've got the momentum, the systems, the processes, and the capital to kind of lock you out. Venture capital helps to even that playing field a little bit. It gives you access to a backer who can help you to come up to that level as well. It'll also drive economic growth. We don't really have to look very deeply into the venture capital field to understand that there's been a driver of economic growth coming out of new ideas from Silicon Valley, from Israel, from the startup places across the world, London, Sydney, Melbourne, even here in Darwin, there's startups which couldn't bootstrap themselves. They had to get some kind of innovation and funding. Things like Speed 3D, which is kind of the Northern Territory darling of startups, and there's plenty of others we can draw from Leandra Swim through to Salty Games, a new startup that's just attracting funding as well. So there's all sorts of different opportunities for driving new economic growth and developing new industries where they don't currently exist, particularly in smaller markets like the Northern Territory, where I happen to be. Also, that providing of strategic guidance is something that experienced venture capital firms and experts in residence in hubs like the Darwin Innovation Hub can provide. And the Darwin Innovation Hub essentially is a philanthropic outpouring from the Paspalis Innovation Investment Fund. It's designed to create an innovation ecosystem, a startup ecosystem to encourage more entrepreneurialism within the Northern Territory. And you find that right around Australia and the world, that this model is very common, that the strategic guidance provided from those experienced in venture capital and investing in startups then pours into places like the Darwin Innovation Hub and other areas as well. So the common requirements for investment kind of start with, I guess, a set of key criteria. This is what the venture capital firms are essentially looking for in startups. Now, from fund to fund and firm to firm, some of those things will change a little bit. Some funds are very much about ethical investments, environmental investments, or ESG investments. Some of them are impact investments around either environmental or social issues, or for instance, they could be something to do with climate change. Other investments are very vertical in nature. They just look at defense, or they just look at maritime, or they just look at agricultural innovation. Where I am sitting at the moment in Paspalis, we're very much a segment agnostic investor. We don't have a specific sector we're looking at. And you'll find that even things like Blackbird Ventures, for instance, don't have a specific investment thesis where they say, we just invest in this kind of company. But their history shows that they're very keen on investing on things like tech, software as a service, AI, those kinds of things. So there's a lot of these firms that do have very specific areas they invest into, and others that don't. Others that just go really with just, is this a good investment that we can work on? So the first thing we're going to look for is the market potential, sizable growing markets that you want to serve that have a very clear and demonstrated demand for the thing you're trying to sell them. So let's go back to my very first startup I tried to create. Well, actually my third startup, I think it was. The others I kind of don't count as much because they never really got off the ground. This one got off the ground and spectacularly failed quickly because I didn't have a sizable growing market to deliver this to, and not one that had any demonstrated demand for the product or service. I didn't attract investment at that time. I bootstrapped it myself with a sizable payout from a job redundancy I got. And because I didn't do that work first to decide whether there actually was any demand for this product, then it didn't work. It didn't go anywhere. So if I had walked into a venture capital firm and said, I've got this great idea, fund me, and they look at it and go, where's the demand for this? Who's asking for this problem to be solved? And of course, there is no problem to be solved there. The next thing is to ensure that market is actually accessible to you. Are they locked out? Is it, say, for instance, you need to have, you're an Indian company trying to get an Australian defense contract? You're probably going to struggle with that a little bit. So that market needs to be accessible and reachable. Suppliers into Australian defense or US defense need to go through incredibly tight protocol and approval procedures to be able to then become those suppliers. Even if you're a government supplier, there's still criteria you have to fulfill. And there's buy local and buy indigenous quotas that need to be fulfilled, or at least looked at, to first provide the opportunity for local suppliers, indigenous suppliers to a certain percentage as well, to be able to get access into that. So you got to make sure that those are accessible, but then also accessible with the resources and capabilities you have. You've produced a new app, you need to get it out to 2 million people to start. What kind of marketing budget do you have to reach those 2 million people? Or do you think you're going to reach them through an email list that you've set up on a website? Or is there some way you can demonstrate that the market you're looking for is an actual market you're able to reach? And they're accessible to you within your resource limitations. Even when you add the venture capital into the equation, that might be something to consider, that you can only reach them because you have that venture capital. So if you can demonstrate they are reachable with venture capital investment or without, then you're going a long way to fit that market potential. Next up, we've got a strong team. Now, this isn't as necessary in the very, very super early stages, because sometimes that strong team is a team of one person who has a brilliant idea. But I can tell you now, it looks a lot better if you're going in there with a team of more than one. Even if you're applying for something like the Business Innovation Program grants in the Northern Territory, having more than one person at the helm, having a chief technical officer or a chief marketing officer or a chief operations officer, and not just a CEO with very limited skills and experience, but a lot of passion, you're going to go a lot further when you can demonstrate you've developed people around you. Now, not all those people have to be paid employees. Not all those people have to be directors of the company. They can be partners that you've brought in. Say, for instance, you're using a marketing agency over there. They're not part of your team, but they work with you to develop your marketing plan, your marketing processes. Or it could be that you're working with an environmental consultancy that are helping you to roll out some kind of engineering challenge or construction project. Having the ability to be able to say, yes, we do have an engineering consultant or an environmental consultant to help us with this project, shows that you've not only identified that you need that, but you've also got that relationship already. That is part of a strong team. It doesn't have to be your in-house team. It can be a team of consultants and external contractors as well, and even partnerships you've developed strategically with other businesses to help deliver some parts of that project. Showing that you've got diverse skills really helps assuage some of those fears that you're not going to be able to deliver this thing. So showing that you've got people who can help you with marketing, people who can help you with the finances, people who can help you with the construction delivery, people who can help you with the technical aspects, shows that you've got coverage of all those key areas of the project you're trying to roll out. So it lets investors know, wow, you've already got this in place. This is great. We don't have to step in and make those things happen for you. The competitive advantage is something that's particularly unique or distinct, at least, that others can't just go and replicate it. It could be a protective advantage. So sometimes it's a matter of a patent or a trademark that you hold that helps you to become a unique competitor in the market that sets you apart from others. Some of it can be that you put barriers in place that deter competition. So for instance, you have the ability to outspend in marketing. You have the ability to outsupply at a much cheaper cost than others can because of the relationships you have with an offshore base of manufacturing or a local base of manufacturing. It could be that you have a warehouse set up in your town that allows you to distribute faster and cheaper than what those who are bringing things up the Stuart Highway from Adelaide, for instance, would be doing, or having to drive it up from Brisbane to Cairns. You've got someone in Townsville who can then deliver that. And sometimes this competitive advantage is the same thing that would give you contracts and tenders, that you're not just coming in cheaper, but you can come in at a much more reliable level as well, particularly if you're going into a market that's known for a lack of reliability. So after that, we're looking at the qualities and characteristics of companies that really are investable, the kind of companies we look at and go, we want to look at that more closely. Now, there's always a due diligence process that has to go through here. So just because you put this in a document or in a pitch deck or say it during a meeting doesn't mean we're going to automatically believe you. A lot of the time, well, all the time, we have to put this through due diligence. So what are the characteristics of the ideas? A little bit of traction, a little bit of growth that you can show on the way to getting that that investment. If you've got some sort of evidence of showing that you've got that first customer at least, or you've got some kind of adoption by a number of users, or some revenue on the table that you can show that in the first 3 months we got this, it shows that there's already some momentum, some traction in the market, and a bit of momentum moving forward. So that could be in the case of construction, perhaps a reference site that you can refer to. You say, this is something we've already built using our system. Or in software's case, it could be, here's software we've already rolled out, a version 1 with 50 pilot customers. So we can see that you don't just have an idea in your head. Venture capital is not really about ideas. I know that there's movies such as The Social Network, which kind of show that you can write something on the back of a napkin and a venture capitalist comes in and goes, sold, here's $1 billion to fund your growth. That's not really how things usually happen, particularly in a more cautious age. Certainly prior to the pandemic, there was a little bit of throwing about of money, like it was lollies being thrown to a bunch of kids. But in some cases, it was more of the tech sector in the pandemic grew massively. So you saw the rise of lots of different ideas and software as a service models, which were delivered over a period of time where technology was taking a lot of the heavy load during a time when we maybe didn't have the mobility and the ability to be able to go and just see people and do business like we normally would. So during the pandemic, we saw a lot of throwing out of money, but now that that's over and the world's kind of back to a different kind of normal, we're in a position where the money is not necessarily tighter. It's just that we're a bit more cautious about it because so much money was wasted in building, software services that never really took off, or building ideas that never really happened. So there's a little bit of what they call dry powder in the market right now. Dry powder is essentially a bunch of money that's sitting in these investment firms and funds that hasn't been invested yet. And it's a little bit slow to be invested because the investments, the committees and the investors themselves are a bit like, we want things to calm down a bit. There's a war over there and a war over there, and China's doing this and Russia's doing that. And so there's a little bit of hesitancy to invest in things frivolously. So we look for these things like traction and growth, and the fact that you've set out a project plan and you've actually achieved some milestones on the way to doing it, rather than just simply having a back of the napkin idea. That kind of idea is kind of dead these days. Very, very rarely do you see that. And the stories you generally hear about that were back of the napkin ideas where someone went, sold, here's $1 million, tend to have been things that happened before 2020, or at least before 2021, when money was being thrown out a lot more easily on ideas. And the whole point of venture capital was, we'll bet on 100 things and 99 of them may not work, but that one will work and become a multi-billion-dollar success. We're a little bit more sensible these days. We've matured a bit. Secondly, observable scalability. This is the ability to scale up your products and services and operations and increase your market share fast enough to give you a foothold in the market that's not as assailable as having a little tiny foothold would be. This means you're efficient, that you've got something that can grow rather quickly. Software generally is the gold standard of fast growth. Manufacturing a little harder because sometimes manufacturing hits very physical limits. Software is like an infinitely scalable thing that can go out in more servers on the cloud. Users can be added very rapidly without really impacting things like customer service, because customer service is generally done online and almost self-service anyway. You don't have people physically having to sell this building or build this building or somehow drive trucks to get those materials out to a particular remote location. So that ability to scale, it definitely makes things more investable. Doesn't mean that physical products are at a natural disadvantage, because scalability is very different in different industries. For software at $29 a month, to be scalable needs millions of people to make that thing really hum. Whereas you're selling a very large piece of equipment, your scalability might just simply be, we can produce one of these a week. And each piece of that equipment is going to cost $1.5 million. But if we can scale up to produce 2 of those pieces of equipment a week, we're scaling up to a $3 million a week business. So that scalability is relative. It doesn't have to be, going out to millions of users. It can be just that you can roll out 2 or 3 of these things, these widgets a week, and that represents quite a significant scale up. The financial health is less about your your records and your financial history, and more about that you've got really sensible and well thought out projections for your finances. You're not saying that we're going to sell 2 billion of these in the next 3 months. You're being sensible and saying, look, at the worst case scenario, we can sell probably 300,000 units within the first 2 years. And then after that, we can see a steady rise. And then we'll see it level out before we introduce a new product, which will see that rise again. Showing your plan moving forward over the years. You don't have to go out for 7-year plans or anything like that. But I generally put in a 2 to 3 year plan to say, this is where we think we're going to go. Based upon all things going well, we think at this point we can grow quite remarkably. A clear path to profitability really helps, or at least a path to a return on investment that someone would make. When you look at a startup that, for instance, I've looked at recently, which is a $29 a month service with a very limited potential market. Let's say, for instance, there's perhaps 100,000 people might use the app, and there could be around about 200 people could be the businesses that would advertise on that app. The $29 a month doesn't make sense when they're looking for $1.5 million of investment. Because as you probably understand, there's a lot of $29 go into $1.5 million. So the path to investment return was actually really low. And most funds are looking for at least a 15% return on investment. But the multiples they would want to see is much higher than that. They'd love to be able to invest $1 million, get back 15 million. It'd be amazing if you can make that kind of return. But if they can make at least 15% back, it means they've made back enough for their investment and the effort they've put in to manage that investment as well. So if you can show that there's a clear path for you to get to at least a return on investment within a couple of years or 3 years, or at least show a pathway to profitability, which shows that there might be room for more investment to go in to make it even more profitable in the future, this will go a long way for you. So how do we then maximize your chances to get invested in? Well, attracting investors is really like putting the right bait out there, demonstrating that scalability, like we talked about, that you've actually got a market that you pretty much sure you can reach, but that market can be grown into. You either have a product which is so competitive that it can get more people into it, so you can steal market share from other providers, or you create a whole new market with a whole new customer base that doesn't even exist yet. That's a significant scalable advantage. A robust business model showing good financial planning ahead. So you're going, okay, we're not just going to make promises of getting 500,000 users at $29 a month. You're going, look, the reality is for the first couple of months, we'll be struggling to get 20 to 30 users at $29 a month. But that's okay because our costs are very low. But it's until we get 2,000 users that we need to scale up, then you're showing what your costs and expenses are against what your income could possibly be. And showing that also you've got some skin in the game. Just walking in and going, I've got a great idea, but I've got no money, it doesn't really give anyone a lot of trust or credibility with you. You go, yeah, I've got a great idea and I'm going to put $50,000 of my own money into this. Great. That shows us you've got real skin in the game as well, because the risk is just as equally there for you as what it is for us. Some market validation evidence is basically, have you got traction? Have you got a first customer? Have you at least, like, there's a lot of times I've spoken to startups before and they're going to set the world on fire because we had a conversation with Telstra, or we had a conversation with, I don't know, the Commonwealth Bank, or with, the owner of that building over there. And they said that they're interested. Well, interest is like a promise. There's no guarantee that thing's ever going to come to pass. So you want real market validation, memorandums of understanding being signed, or an agreement to purchase has been signed, or even very early buying into it to test and trial it out, or at least showing that you've got some pilots people in there who may not be paying yet, but they're testing it out for you. That gives you some market validation that what you're producing is something that people actually want, or that somebody who's got a lot of money wants to pay for it once, be it governments or corporations or businesses or individuals. And an effective way to go to market, this is often what a lot of founders fail at. They're very, very good at coming up with technical solutions to problems. They're very, very good at explaining to someone why this solution is so important. They're very, very good at even looking at what the market is that may want to get that product. but they're not so good at planning out how they're going to reach those people, how they're going to actually sell that thing through to them. So that's a whole different level. So your business fundamentals pretty much are about having a customer acquisition strategy. How we get that first customer? How we get that first little group of paying customers? What have you got in place for that? Your financial management's intact. You've got a very good approach to making sure that you're going to make money, how you're going to approach things when you hit a funding limit and you need to get more money. Where is the money coming from now? What is your skin in the game? And making sure you've got a lot of differentiation in your product, making sure that you're not just reproducing something that someone's already done with no plans to at least market it in a different way or aim it towards a different set of people. You've got to have some kind of thing that's different that people either haven't done before, haven't noticed before, or at the very, very least, perhaps it is, a very different approach or a different spin on something that's already being done. And then to self-assess yourself before pitching is very important because you don't want to walk into a room where they just slam you down with 100 questions. You walk out going, oh my God, I feel like the biggest failure in the world. Just do a little bit of self-assessment. Look at whether you have financial stability in place already or whether you've got a path to it. Even if you're not financially stable and this thing's just taking all your savings at the moment, making sure you can then at least articulate that. Say, yeah, my cash flow is not great. I've got debt levels here, but this is all on a path to stability that I can show in this graph or show in this set of figures that are showing that, yeah, while the debt's there, it's coming down and we're going to be turning that around. With this investment, we can turn it around quicker, but even without it, we reckon we could turn this around within 2 years. So having that kind of self-assessment of your finances is great. Having some self-assessment around your growth potential, really looking at even the worst case scenarios. If we can't reach 1 million users of this at $29 a month, what could we reach? What is the worst case scenario that's enough to show that there's still a pathway to profit? And that can be based on historical records. It can be based on comparative stuff from other market leaders, other companies, looking at the trends in the market, and then setting future projections that are sensible, not crazy. Like when you put crazy numbers in front of people, the first thing they tend to believe is like, that's a load of crap. That's just rubbish. You're never going to get that. But if you get something which is a lot more believable, and there's a certain psychology and some financial modeling around that can help, then there's a market fit. Is the thing you're doing actually for the people you think it's for? Have you found a fit? And that can be based upon, what the expansion and scalability has been of others, what the fit has been for others who tried to do this as well. And I guess then there's a competitive positioning. What are others doing? Do you know who your competitors are? Is that $3,000 per piece that you're trying to sell? Where is that $3,000 coming from where it's currently being spent? Is that being transferred from another supplier in competition with you? Or is this new money that someone has to come up with that's outside of their regular budget for the kind of things you're doing? Looking a little bit, that really, really helps. And then some market demand assessment. So again, is the market actually demanding what you're doing? Evaluate that, go deep on that to make sure that there is some demand. And that might mean doing a bit of empathy work, going out and actually asking people, putting a test out there, a Kickstarter project even can help you to assess whether people actually care about what it is you're trying to do. So some important metrics to consider: revenue growth, your customer acquisition cost. How much does it cost you to get a new customer? If it's costing you $37 to get a $29 customer, you've got problems. If it's costing you $12 to get a $29 customer, you may have something there. How quickly do people dump you? They churn rate. So they start with you, they get you for a month, they go, yeah, I'm out. How many of those people are dropping off? So I know there's a business called Leonardo.ai, and they are like one of those AI image creation software. They're a startup in Sydney. They've got like about, I want to say about $19 million of funding or something crazy like that. Their problem is they've got a massive churn problem. People come in and they just drop off. And I'm one of the drop-offs as well. I used it and went, too complex, don't like it. Too many other tools that do this better. I don't care about that. I'm just not using that. So they come in, test it for a month for the free trial and drop straight back off again. And there's some figures I heard with Leonardo were about like only about 5% of customers actually stick around and pay for the paid version of it, which is a massive problem they need to overcome. Gross margin, so how much are you making on top of what you're spending, your burn rate, so that you've got a certain amount of funding, got $50,000 of your own money, how quickly you're drawing that down, because that gives us an idea of then how quickly you'll draw down your venture capital money. If we give you $1 million, how quickly are you going to burn that down? Are you going full Lamborghini and buying $60,000 boardroom tables, or are you going sensible to the secondhand shop and making that cash last as long as it possibly can? What's your monthly recurring revenue? What is your runway? How much money have you got left to work with? Your user engagement metrics for software. How much market penetration have you had? If you're going into an established market, if you've got 2%, 5%, 30%, have you had any kind of market penetration? Have you got a lifetime value? So a customer lifetime value, spending $29 a month for 10 months is $290, right? But what if they stay on for 5 years? What is that converting to your customer acquisition cost? Because if it's costing you $37 to gain a new customer who pays $29 once, that's a loss. But if it's $37 to gain a new customer at $29 and they stay with you for years, well, then you've got a great lifetime value, and that's a good return. We want to know what those kind of things are. So if that helps, that's really good stuff to help provide. Now, when you go to prepare your pitch, we want to see a little bit of how you articulate the problem and your solution in the most concise way possible. If it's really super complicated to explain, like a lot of technical things are when they're presented to us, you're going to struggle, because if we can't understand it, we certainly won't invest into it. So if it's something so technical and so harsh, maybe get a marketing person in to sort of go through with you how to dumb that down enough so it's very clear what the problem is and what your solution does. That unique value, that's a workshop on its own to work out what your unique value proposition is. What is it that you do that others can't, or that you do that others are just not doing? What is the opportunity of the market? Again, like, this is the stuff to highlight in your pitch deck, a market opportunity. And part of the Croc camp that we're going to be doing from August onwards towards October, when we'll be running Croc Pitch, will be around this. We'll be helping you to build out that pitch deck, so to understand how to present it in a way that the investment committee and the judges can actually see what it is you're doing. So market opportunity is one of those things, as is your revenue and sustainable growth, those business metrics that we need to know about. What's the model? Explain how you're going to make money, because that's a really important thing too. Explain, basically, you say there's a big opportunity. We go, how are you going to do it? What are you going to charge? Is it a subscription? Is it a once-off? Is it funded by grants? Whatever it is, how do you make your money? So to come to an end, venture capital is about capturing the value between the startup phase and the public company phase, which is all about basically how much your business is going to rise between when you first start up and get that first investment to whatever the next phase happens to be. Sometimes it could be an IPO. It could be you going public on the stock exchange. That's probably a bit further down the track. Or is it just simply going from that first investment to the next investment? Because sometimes, as a venture capital firm, we'll come in with a small investment to help you get going, and then we will exit with our return once you go for that next round of funding. Let's just say you want $100,000 to get going. We help you out with that. Then we get to the next stage and you say, well, we need like $5 million now. The kind of investors that come in with that kind of money would then probably buy out our share, so that then we step out with our return, because your valuation of your company has gone from, maybe $500,000 to now being like a $22 million company. That's a significant return on investment based on the value of that company alone. So there's a lot to consider. I know there's a lot to go in there, but if everything was easy, everyone would be doing it, and that everyone would be accessing it, and it wouldn't be valuable to anyone.